Sunil Koul joins us now, represents Goldman Sachs. Let's connect with him. Let's understand what his current market positioning is and how he sees that things essentially moving. Sunil, are you a bit surprised with the way how markets are moving? 4th of June onwards, the market which hit a panic bottom, we've seen a one-way rally.
Yeah, I mean that's right. Look, I think we are a bit surprised in terms of how quickly the market has come back. But I would say, look, if you sort of think about since election results until now, not a lot of things have changed, right? I mean, there is broad policy continuity in terms of all the key ministries still being retained. We still think there will be fiscal sort of consolidation, sort of closing to 5.1% in terms of the fiscal deficit target. We think the government will continue to have infra focus, maybe a little bit more labor intensive, given election results. Maybe some of the financing goes to off balance sheet, but broadly kind of still focus on infra, a little bit more higher tilt towards welfare spending and rural. But broadly speaking, I think the two things for India which continue to be the drivers here is that you continue to have very strong macro stability for India, and B, you continue to see earnings coming through. And if there is broad policy continuity, that means people still think India is one of the best stories out there, which is why I think the market has obviously come back pretty strongly. And obviously there is some element of flows coming back. Retail kind of bought the dip, and then we are actually seeing foreign money now finally coming back in over the last sort of 8 to 9 trading sessions, close to $3 billion already inflows, right? So we put all of that together. I think that's why the markets are where they are. I think we still remain overall constructive, as I said, given the strong growth backdrop.
Sunil, hi, morning. Thanks for joining in. So given that foreign money is now making its comeback, are banks the obvious trade, or are they going to chase SMIDs this time?
Look, I think there are a lot of sort of intra-market themes which we like. Obviously, I think banks continue to be a large portion of the market. Within that, we still, on the margin, like private banks over PSU banks, given they got kind of superior balance sheets and better ROAs. I would say beyond banks, there are a lot of the themes which we still like within the market. There is sort of the broader theme of energy security. There is the theme of services, high value add services exports, the GCC theme, the tourism theme. We think things like defense, railways continue to do pretty well. And I think agri is obviously getting a lot of the focus in terms of better farm productivity, food, chemicals, fertilizers. I mean, we still like that broader theme. So I would say banks is obviously one of the large parts of the market, but there are a lot of the intra-market themes which we think there is still a lot of value out there, and we like those.
But on which end of the market you are, Sunil? Because there's part of the street which believes that the next leg of outperformance will come from consumption purely because the sector hasn't done much. But then there are others who still believe that capital goods and industrials is the space where the momentum will continue to be with. What will outperform, consumption or industrials?
Yeah, I mean that's a great question. Look, I mean to be candid here, we were before the elections, we were in terms of our allocations very much favoring the broad investments or manufacturing over consumption. So we had sort of power and utilities as overweight, we had infrastructure as overweight. We did like the broader real estate recovery story and the way to play it through the building materials. We were actually underweight most of the consumer segments, including staples, consumer durables. We also were underweight some of the consumer-facing banks, specifically ones that are more geared towards unsecured credit, right? Post the election, the one change we have done is that we have neutralized staples from being underweight to market weight. And so, as I said, our expectation is not that there is a pivot towards consumption over investments. We think some of the infrastructure things, as I said, will continue to perform well. But there will be a slightly higher tilt towards welfare spending. So that means maybe kind of staples do a little bit better. Again, if you think about sectors, we do like autos. We have been overweight autos for a while. But again, if you think about sort of investments versus consumption tilt there, on the margin, we think maybe two-wheelers, three-wheelers, tractors, they may perform better. So even within the same auto sector, we are a little bit tilting towards kind of the rural side of things. And as I said, staples, we have neutralized that. But within staples also, if you sort of granularly look at that, you got the HPC segment, and then you got the food, the companies that are more geared towards sort of food. And we think home and personal care probably does a little bit better there. So I think you can kind of pick the pockets. I wouldn't say it's investments or consumption. I think we are sort of pretty balanced in our overall allocations post elections now.
Sunil, is the base case assumption a meaningful rural recovery, or is it placed purely on valuation comfort? Some of those pockets that you talked about.
Look, it's not a strong rural recovery we are baking in our numbers, because I think the fact remains, as we know, that numbers have kind of bottomed out to a large extent, right? And we were a few quarters back, as we all know, the FMCG volume growth was kind of negative for many quarters. In the last few quarters, it has turned kind of positive, low single digit up, right? So fundamentals have bottomed. We're not expecting a huge recovery from here in, but I think at the margin, sort of slightly higher spending towards kind of welfare schemes and subsidies should help rural recovery. Obviously, we are carefully watching how the monsoons play out and how the sowing season happens, and I think a lot depends on that as well. But broadly speaking, directionally, we do think the rural segment should somewhat look slightly better than they have been in previous quarters.
The call is that you overweight insurance. Why is that?
Look, I think for insurance there are a couple of things going on. One, obviously, the two main drivers there will be. One was the large sort of overhang for the last, I think, 6-8 months around the surrender values. I think that largely is behind us now with the ruling now. So you got a big overhang which is largely behind us, and at the same time we do think that sequentially numbers should be improving for the sector, right? I mean, obviously you had a pre-buying because of the tax arbitrage between mutual funds and insurance a year or so back, and the numbers have been softer. But I think we are getting to a point wherein that sort of base effect is going behind, and so we do see sequentially APE numbers improving. And at the same time, if you got the sort of regulatory overhang also behind us, we think the sector could trade better. I mean, there is obviously the broader structural kind of under-penetration story behind it, but I think that the sector hadn't done well in the last couple of years because of these issues, and both in terms of numbers but also in terms of the regulatory overhang. I think with those behind us, we think the sector could trade better. It also is a relatively defensive sector overall when you compare it within the broader financials, and so I think that also is another point for liking the sector a bit more.
While we may start feeling happy that FIs have stopped selling, they've not really come back. Even though the India narrative is better, even though...
Look, I think the starting point, as we all know here, I think the starting point was low, right? So foreign ownership in India is at 11-year low. We do talk about people like emerging market and Asian fund managers being marginally overweight, but beyond banks, they're pretty much underweight in a lot of the themes we just spoke about, right? So and global guys are still underweight India. I mean, from the various investor conversations we are having, people are still very keen to increase allocations in India. So I think the starting point remains that foreign allocations are light in India. Now, I think if you look at the last sort of 8 to 9 trading sessions, we have actually bought $3 billion in aggregate. So there is a meaningful pickup in FII allocations in that sense. I mean, obviously you could argue how much of that is not through blocks versus how much of it is sort of a real sort of secondary market sort of buying. But there is clearly kind of increased appetite from foreigners post the elections, what we are seeing. What's also interesting is that in the last couple of weeks, we are seeing, and we mentioned this in one of our recent reports, we are actually seeing some of the India dedicated offshore funds as well as the ETFs getting sort of decent inflows, north of $1 billion in the last couple of weeks, so $2 billion plus. And that's both in terms of ETFs, some of these large iShares, MSCI ETFs, but also some of the long only India dedicated funds out of Europe, US, and Japan. These are the 3 allocations where India dedicated funds are getting inflows in the last couple of weeks. So I think that's an encouraging sign. So if you put all of that together, there are definitely data points that are suggesting that foreign investors are increasing their allocations in India.
And yes, the foreign investors are looking at incrementally positive on India. But Sunil, I was just going through your report. You do have a target of 26,000 on the Nifty for June 2025, and you talk about a lot of alpha ideas, the likes of tourism, service exports as well. And with the kind of commentary coming in from Accenture, what's the view on IT now?
Yeah, look, I think when we sort of talk about services exports there, I mean, it's the broad theme of the GCCs, the global capability centers, which have obviously kind of doubled in the last 10 years or so, like close to 1,600 odd GCCs and sort of employing 1.7 million people. So I think that's what we mean by the high value sort of exports. And that obviously that feeds into some of the commercial real estate space, that feeds into some of the consumption in there. So that's I think one big sector. For the IT services in particular, with the commentary as you mentioned, it still feels that you got probably 1 or 2 quarters of sort of weakness in the numbers still there. And so even though it's a sector where numbers have come down a lot, it's sort of broadly underperformed. If you look at the more longer term last 2-3 years, we do feel that it's probably still a couple of quarters early in terms of sort of getting into the sector. So we would rather be still focused on the domestic sectors in India, some of the themes we just spoke about, as opposed to the external facing sectors at this point, including IT.
Great to have you on the show. Thank you so much for taking the time out and speaking with us today.
If you like this video, then like, share and subscribe to ET Now.